let's talk a little bit more about CLT or CLAT, a CLAT, the Charitable Lead Authority Trust. This is another thing that was kind of
Yeah.
mind-blowing to me the first time we had this discussion, because this is a way that anyone can buy real estate, donate to charity. If someone is donating to charity already, this is something that it just makes it way more beneficial for their own tax benefit. And often when people do, create generational wealth through real estate,
Yeah.
they set up these type of things. But
Absolutely.
let's
So
talk
Jim
about
and
that.
we have always supported charity in our church, and so we got certified in charitable planning back in 2001. And we love these strategies. They're center stream with the IRS. They've been codified in the code for since the 60s,
1969.
1969. And so just the concept is you buy a piece of real estate. Let's say that real estate has $100,000 of equity. So it doesn't matter if it has a mortgage on it or if you bought it free and clear. It's $100,000 equity. When you take that property and you transfer it, quit claim it to a charitable trust, you get $100,000 tax deduction. And you're like, what? How am I getting a tax deduction? I'm just transferring title to this charitable trust. The reason why you get $100,000 deduction is because you are making a promise to give those rents to charity over the next 15 years, 17 years, that will equal $100,000. So just to keep math simple, let's say the net rents is $10,000. So you give $10,000, and in 10 years, that's $100,000 plus interest. So it might go another 2 years. So that'd be 12 years. And at the end of the 12 years, the trust has given away $120,000. It's fulfilled its obligation, and now the trust is dissolved, and you get the house back. So your family.
Did you say you get it back?
Yeah, you get it. So the family, the family gets to retain the asset. You're never giving away the asset. You're giving away future rents. So it's huge leverage. And right now, the interest rates are still favorable. It still makes really good sense.
I mean, the beautiful thing about this is, yes, this is participation in charity, but really, this, in my mind, is to some degree retirement planning. Because if you don't say necessarily need, if you're a high income earner and you don't need to live off of that cash flow from that property, and you can pay it back at whatever length of time you really need to, or sooner or later, as long as you pay that back to the trust or the promise and fulfill that IRS need. It allows you to take a huge tax deduction in year one, but
Yes.
then also get that tax deduction and have that property be coming back to you once that payment to the charity is fulfilled. Charity is a great thing to participate to, but you can also use this strategically as retirement planning, where you can, at some point when you do plan to have that be, you're living off of that or pass it on to your family as a retirement picture. You can get that tax deduction in year one and be very strategic with that. I love that.
Now, does if you put it in the trust and you're donating all the profits to it, I'm assuming you're still in control of the property. You're paying the mortgage, you're paying for any repairs, you're putting tenants in and all of that. You're not completely giving away like all control of the asset, or are you?
In theory, you shouldn't be managing the property inside of a charitable lead trust. That's considered self-dealing. Now, if you're like any of the other real estate investors I've ever dealt with, you hire a property manager and then manage the manager. That's okay. All right. The money that the trust earns sits inside the trust until you complete the promise to the charity. Then it all comes back out to you, the family.
So to answer more detail, Adam, you as the donor are the trustee of the trust.
Yes,
so
you're the boss.
It's very similar to a self-directed IRA, right? In a self-directed IRA, inside of that, circle there, the property's inside of there. So an IRA pays the mortgage, an IRA pays the property tax. Well, the trust pays the mortgage, the trust pays the property tax. You have a checking account, you're the trustee, you write the checks.
Yep.
You write the checks for
Yep.
the property tax, the insurance, or people have auto debit for the mortgage. So it all comes out of that trust.
So
Did that make sense to you?
Yeah, but what happens, just out of curiosity, let's say 7 years down the line, I think, this property, it's time for it to go. I need to sell it because of one reason or another. How do you, just on sale, do you put the money back into the trust to pay it off, or how does that part work?
if I could.
Yes.
You can either do a 1031 exchange and keep the trust running, or let's assume big fat stupid check syndrome. You paid $100,000 for the property. Somebody's offering you $200,000 for it. You're 7 years in, so you owe another 5 years worth of income or $50,000. Great, sell the property, go to court, say, hey, I got the $50,000. I want to pay off the charity and call it quits to the game. Yep, no problem.
So you're just paying the difference of what's still owed potentially, or keeping it going.
As long as you pay what's due to the charity, kind of like what you would do if it was a loan to a bank, as long as you pay to the charity what you promised the charity, that's really the critical function inside the trust. But other than that, yes, you can exchange the assets, improve the assets, sell the assets, diversify, all of those good things. Now, here's a real fun one. I'm going to slow some of these pearls together that we talked about. I'm going to pick on the Adam that has 11 children for a minute. Okay. Adam has 11 children. He sets up the real estate. He becomes a real estate professional so his wife can continue her W-2 job. She gets a great big bonus. And so they've got a tax problem. Adam thinks quickly, I know, I'm going to come after and get some tax deductions. He goes to look at his real estate. Somebody's offered to buy a piece of real estate, and it's a big, fat, stupid check. He can't say no. He sells it. He's got even more tax problems. No problem. Because what we can do, Adam, is we can borrow other people's money, use that to buy additional real estate, get a cost segregation report, and oh, by the way, put it inside one of these charitable trusts. Do we see what's going on so far? Do you remember the 11 children? 1, 2, 3, 4, 5, 6. Okay. By the way, if you've ever been in a room with 4 children and tried to count them, you'll get to 11 pretty easy. Okay. Here's the point. There are so many tax tools available to us. I'm not much concerned about the tax this year. I'm more concerned about what's important to you and your family. Imagine sitting down with your kids and asking them, okay, kids, we have a charity. We have a promise to give money to charity. Which charity do we give the money to and why? And you ask your kids that. What are you doing? You're teaching them heart. Yes, you're giving them all the mechanical knowledge on how to invest and make money and all the rest of it, but now you're really training their heart. And that can make a huge difference in the future of this world, in my opinion. Save the tax, keep the kids on payroll. Don't worry about the tax when you sell the assets, because we'll figure that out. And now we can actually serve a greater good.
Yeah, I was about to say you pay the kids for the meeting, right? For the meeting that you have about which charity, you pay them for that meeting, right?
Oh yeah.
If they have an actual charity, if you actually set up your own family foundation or in fact your own charity, yes, you can put your kids on payroll.
Yeah, I think that's one thing that we talked, offline. We talked a little bit about when you were doing the donor advised fund and actually having some allocation. I don't know. I would say that's beyond the scope of what we want to talk about today. But just real quick, I mean, in theory, you could, right? I mean, you could set up your own family trust and actually pull a wage off of that for someone that is truly managing that. That would be at the level where you were actually have a larger trust that's compounding year after year. But the point is once you kind of open the door to these type of things, it's very exciting. And I think that's really ultimately what drives most people to invest in real estate big picture. I mean, we covered a lot of just pretty intense stuff today, which is also very exciting. I would hope for most people, or at least eye-opening to, hey, there's a better way to do things. There's a little bit more strategy that maybe I need to educate myself on, hire the right professionals and learn about it. If nothing else, just learn about it and then learn how to apply it. But ultimately, real estate investing at a high degree allows you to become financially literate replace your income, become financially independent, and create generational wealth and be contributing to society through these charitable efforts. I mean, those are all things that are outstanding. Most of us strive to achieve those. It takes time, right? It takes education. This isn't easy for most people, but it is surrounding yourself with the right people and taking those action steps to educate yourself and apply all the strategies that we talked about today to some degree. So this is why I love this stuff. This is very exciting to me, and the type of stuff that we're doing actively with our family, with our children, with our business, year after year, and we encourage everyone to do the same. So is there any parting words on the tax side? I mean, obviously, I think this is something people should go back and listen to and learn about, and obviously reach out, Lorraine and Jim, to you guys. It's renttoretirement.com/tax to get some information if they want to have that kind of initial analysis that you're offering at a 80% discount, I think, for $97 to Rent to Retirement clients. But more importantly, to set up a time to actually go through an individual strategy with you guys. I mean, any final words as we're right around the corner from tax season that you'd like to remind people about?
Well, I would just say it's worth it to just get a quick initial analysis, I would say, or evaluation. I would say that probably 100% of the people are missing something. Could be small, could be big. We see it all the time. I don't know. I just can't express it enough, because people don't know what they don't know. There's a lot of opportunities, and it took us decades to learn everything that we've learned. It's not something that happens overnight.
Yeah. It's not like there's some course out there to teach you how to be a strategic thinker when it comes to tax. So yes, years and years of experience, years and years of training in various disciplines. As you notice, that our conversation is going all over the place. It hasn't just been about the 1040 or the Schedule E.
Yeah.
The bottom line is this: get an evaluation, know where you're at. That's so important, because that can help you decide more effectively what you want to do in the future. Okay. Make sure you involve your children. They need to learn this stuff. This is not just for the adults to play. Okay. That's for you, Adam, all 11 of them. Okay. And the bottom line is this: we're very excited to work with you. We're so happy that we can bring value to your investors to help them grow their real estate portfolio even more.
Yeah. Well, thank y'all so much, Jim and Lorraine, for coming on the show with us today. Once again, Jim and Lorraine are tax strategists for real estate investors and are offering a free 2-page resource about the real estate professional rules. I know whenever I was looking into my real estate professional status, it wasn't very helpful, because you just read the exact same thing on every single web page of, this is what the IRS says. And my response was, well, what does that mean? And the answer was, good luck figuring it out. So you can see that 2-page resource they have at renttoretirement.com/tax. You can also sign up for the $97 initial tax planning evaluation that, as Zach mentioned, is at an 80% discount for rent to retirees. So really appreciate y'all taking the time with us today. For everybody else, thank you for listening to the show. Thanks for sticking with us for this, probably our longest episode yet. But it's a topic that requires a lot more depth. So check us out at renttoretirement.com. Don't forget to leave a review on your podcast platform. Really appreciate the time you've spent with us to educate yourself, and we'll see you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.